Hi friends, if you want to build wealth, always remember these two rules. Rule number one is protect your capital, do not take unnecessary risk. And number two is let the data make investing decisions for you. Don't allow emotions to make your decisions. In this video, I'm going to run you through 5 investing strategies that are built around these two rules. I've been personally using these investing strategies. You're going to learn a lot in this video and are going to not make those mistakes that you've been making for a number of years. If you don't know me, my name is Rahul Jain. I'm a SEBI registered research analyst. With that, let's get this video cracking. First investing strategy is laddering strategy. This strategy applies to lump sum investments. So whenever you want to invest any lump sum amount, be it 5 lakh rupees, 50,000 rupees or 5 crore rupees, you need to use this laddering strategy. What is this laddering strategy? Let's take an example of gold right now. The gold is down by almost 24% when I'm recording this video. Now let's say that you want to put money in gold. Of course, it's not a recommendation, but let's assume hypothetically you want to put 10 lakh rupees in gold. Should you go and put that money in one go? That entire 10 lakh, should you put that in one go or should you stagger it out? So in my view, you should stagger it out in multiple batches, okay? Because you don't know whether gold prices will come further down or whether they will go up. Nobody can really predict where the market will go or where the prices will go. By staggering it out, what you are doing is you are averaging your cost and you're not going to panic. Because just imagine that you put 10 lakh rupees, okay, at this price right now. What happens if gold is down by 5% in the next few days? You will panic. You will immediately try to sell it off or you will panic. Oh, what is going on? What is going on? What is going on? That volatility is what you need to avoid so that you can remain invested, because a lot of people put their money and as soon as they see their P&L in red, they will panic, they will sell off and book losses. We don't want to do that, because I'm assuming that you're investing it for some long term, maybe 5 years, 7 years, 10 years or whatever that period is. Okay. Now the question is, how many multiple batches should you use to invest your lump sum amount? So there is no thumb rule here, but let me show you some data about Nifty 50. It will make my case very, very clear here. Okay. What you see on my screen is Nifty 50's last 25 years of data. And one point is that whenever you're investing lump sum in Nifty 50, generally 7 years, minimum 7 years is considered a very, very good time period so that your returns expectations are better. It is likely to give you more than 10% given the past data track record. Now what I've done is I've taken two scenarios. Scenario number one is, let's say you are putting all your lump sum money in one go. That you see in the left side of my screen. Okay. And scenario number two is that you are staggering your money around 6 months. So 6 multiple batches is what you're putting in Nifty 50. Okay. And let's see what happens. So overall, if you look at the 7 years period, if you hold this money for 7 years, there is not a much difference in the returns. Okay, because 6 months is what you have spread out your money and over 7 years it almost averages out. There's no major difference in returns, but the difference is in the year one. Okay, so focus on year one column here. Okay, what you see here is that whenever the market has gone down in the year one, for example, if you look at January 2008, market was down by around 50%. Okay, here in the left side where somebody has put the lump sum money in one go, they would have seen the portfolio going down by around 50%, while in the second scenario only 41%. So there is less volatility in the second side. Whenever there is a bull run, for example, January 2003, here the market went up by almost 79%, but here in the 6 months staggering you got 93%. So even both bull run and bear run cases, if you see overall, generally 70-80% of the time your volatility will be lower. Okay, that is what the data is showing. Over the long term, it may not matter, but you need to be in the game to remain long term invested, because in the year one, when you see this huge volatility, I'm not saying the market will go down by 50% or whatever, but if you see huge volatility, what happens is we all panic. And when the panic kicks in, we just sell off. We book losses generally and we sell off. And we never return back to that asset class because we have burnt our fingers. I don't want you to do that. Okay, just make sure that you put money in any asset class under, let's say, 6 batches, 3 batches, 4 batches, whatever you're comfortable with, depending on your risk appetite. So this is the main thing that you need to learn. But more importantly, there are a lot of other things I have covered in this video here. Okay, lump sum money, how to invest, when to invest, where to invest. This video is on my Hindi channel, just released few days back. Please go and watch this video. You will understand the entire game of lump sum investing. I'm not going to repeat all of that here. Okay. Your next question will be, Rahul, how do I go and put these money in 6 batches? Is there an automation? So if you want to put this money in mutual funds, then there is an automation. What is that automation? Let me very, very quickly show it to you. So I'm pretty sure that you might have heard about STP, Systematic Transfer Plan. It's a very simple concept. Let's say you want to put 10 lakh rupees in mutual funds. Okay, what do? First you put that 10 lakh rupees in a liquid mutual fund. So for example, here on my screen you can see a liquid mutual fund. Okay, once you put that money in liquid mutual fund, from there if you go here and click STP, you will see an option start STP. Okay, you go there and you say that, let's say 10 lakh rupees, or let's say for simplicity 12 lakh you want to do. So I'm going to say 1 lakh rupees every month. Okay, if you're doing for 12 months, or if you're doing 6 months, then you could say 2 lakh rupees. Okay, so I'm going to say 2 lakh rupees here. All right, and you do monthly basis. Every first take this money out, okay, from here and put that into various mutual funds that you like. Okay, for example, here let me select 2-3 mutual funds here. Okay, select here, and you can also say what is your allocation here. So for example, you might say 50,000 go into this one. All right, 1 lakh rupees go into this one. Likewise, you can create your own allocation as well. And what it does is automatically on the STP date, what will happen is that from your liquid mutual fund, 2 lakh rupees will come out. It will go to your bank account, and from that bank account, 3 mutual funds, the way you have done the allocation, it will automatically go and put that money in. So this is an automated way of putting your money. This facility is only in mutual funds. If you want to put in a gold mutual fund, you can utilize this. But if you're buying physical gold, then you will have to do it manually. There is no other way, right? You can do this in stocks as well. Some of the brokers allow that. Again, I'm not going to go detail out the demo here, but I hope you get the concept that by spreading out your risk, you are likely to stick with your investment. That's my entire point. So this is point number 1. I hope you learned something new in that. And if you like this strategy, let me know in the comments, ladder strategy. I would love to read your comments. With that, let's go to strategy number 2 now. Strategy number 2 is gunpowder strategy. I know it sounds very fancy, but let me simplify this. What you see on my screen is Nifty 50's inter-year decline. So almost every single year, 10 to 20% of temporary decline is seen in Nifty 50, broader stock market. And what do we need to do? We need to have money in cash. Okay, so that whenever this happens, we can deploy that cash. Okay, not only 10 to 15%. If you look at the history, every 7 to 10 years, Nifty declines may be between 30 to 60%. It means deeper market corrections happens every 7 to 10 years almost if you go back to the history. Very interesting data point. If you see January 20 COVID time, Sensex was at around 42,000 almost, and it fell to almost 25,000, almost 50%. Half the damage was there by March 20. Okay, just imagine putting your money at that time, right? See where the Sensex is now, almost touching 80,000. Within 5 or 6 years of time horizon, it has gone up by almost 3.5 times. Okay, and it's not just about Nifty 50. Have a look at my screen. Mid caps and small caps are even more volatile. Within a year, 47% of the days, Nifty mid cap will be below 10%. Okay, likewise small caps, almost 64% of the days in a particular year, they will be down by 10%. So these are very good opportunities, and it's not just about equity or stock market. Have a look at gold. Almost every single year, gold also goes down temporarily by 10 to 15%. These are very good opportunities for long term because the valuations are down. There is a good price that you can buy at. Even if you look at large cap, mid cap and small caps within the equity segments, you will see that there are asset classes or there are market cap wise underperformance. For example, in 2025, small cap was down by almost 5% at the end of the year. Good opportunity, right? If you look at by sector, okay, there also you will see very similar pattern. For example, real estate sector, 2023-24 all-time high. What happened to 2025? Down by 17%. 2026, so far it is down as well, right? These are opportunities, absolutely opportunities in my view, right? Point is very simple. You need to have the gunpowder ready, cash ready, so that you can deploy when there is a fear kicking in any asset class that you want to pick in. It could be direct individual stocks as well. I have a watch list where I have a list of stocks. Okay, I want to buy those stocks, and there I will only buy them if the price drops to a certain level. Okay, they remain in my list forever. That's okay, but I'm not going to buy them until they drop to a particular price level that I want to hold them at. And the recent example I can give you is in the month of March, US-Iran war kicked in. See after that what happened. Mid-cap 150 has rallied to almost 22%. Okay, if you look at small cap, they have rallied by around 28% when I'm recording this video. If you look at micro caps, they are rallied by around 35%. So within 3 to 4 months of time period, the returns are massive. Why? Because if people had money, they would have deployed that time, and the returns are really great. Now the natural question is where to keep this cash. Okay, so there are two options. One is debt mutual funds, second is fixed deposits. Okay, now if you are able to find good debt mutual funds, you can do that. But if you don't want to get into complexity of debt mutual funds, FD is the simplest option. Now to create FDs digitally, you can go to Stable Money, partners of this video. Stable Money has more than 60 lakh users that trust the platform for their fixed income investments. In fact, in 2023, I did my first fixed deposit with Stable Money. That FD is still there. It is going to get matured in 2027. The interest rate at that time I got was around 8.18%. You will find two types of fixed deposits. One is the mainstream banks FDs, for example, ICICI Bank, SBI Bank, HDFC Bank. And second is small finance bank FDs, for example, Utkarsh, Shriram Finance, etc. Now, interest rate wise, you will find that the mainstream banks interest rates are lower and small finance bank interest rates are slightly higher. And when it comes to risk, mainstream banks are definitely carrying lower risk than the small finance bank. There is no doubt about that. All bank FDs are insured by RBI's subsidiary called DICGC, and up to 5 lakh rupees per bank per PAN card is insured so that your risk is covered. So whenever you want to put some cash in FDs, then you go to Stable Money platform. You can compare more than 200 banks interest rates there. Right now, for example, the maximum FD that you can get is for 8.50% annual interest. And that is one of the India's highest FD rate that you will get. Another reason that personally I like Stable Money is that you don't need to open bank account while you're opening your fixed deposit. For example, let's say you want to go with a small finance bank. Let's say Shriram Finance Bank. Now, in order for you to open the FD, otherwise you have to go to the branch, open the bank account, etc. All of that you don't need to do if you follow the Stable Money process. As soon as you do your FD, you are going to get an email just like this that I got back in 2023. This FD you will be able to track on Stable Money platform, and whenever you want to redeem it or break it, you can go to Stable Money platform and redeem this FD. So imagine all your FDs are at one Stable Money platform. It makes the tracking very, very easy for you. And by splitting your money into multiple bank FDs, what you can do is you can take maximum advantage of this 5 lakh rupees limit that DICGC provides you for insurance. In my view, that also is fulfilled by Stable Money because you have multiple bank options there. One important point here, your money is in the FD from the bank, not with the Stable Money platform. In case you want to save money every single month, then you can also explore RD's option. I've given you the link of Stable Money platform in the description and in the pinned comment. With that, let's go to strategy number 3 now. Strategy number 3 is 7 years rule. So whenever you want to do SIP in any asset class, minimum time period that you need to put your SIPs for is 7 years. Okay. For example, let me show you the data. If you look at Nifty 50 returns, okay, historically what we have seen is that if you do SIPs for 7 years of time period, your returns, which are likely to be more than 10%, if we analyze the past data, goes up very, very high, almost in 80% possibility. Okay. But if you only do SIP for 1 year or 2 year or 3 year, which is the case right now, a lot of people started saying SIPs are bad because last 2 years Indian stock market did not give much returns. Okay. Therefore, everybody started saying SIPs are bad. Actually, SIPs are not bad. The rule is 7-year rule that you need to remember. Nifty 50, I've shown you the data. You can see on my screen. If you do it for 7 years, then 80-85% chances are there you are likely to make more than 10% returns given the past track record. Again, it's not a guaranteed return, but the chances are there, right? In fact, if I show you Nasdaq return, Nasdaq 100 US stock market return, very, very similar pattern you will find. If you do 7 years minimum SIPs, then the chances of you generating more than 10% goes very, very high. Okay, as compared to doing only 1 year, 2 year. But most people, what they do is they will do SIPs for 1 year, 2 year, maximum 3 years, and then they will start to get panicky about it that SIPs are not making returns. SIPs do not give you returns in the short term. Please remember that. I also did the same analysis with gold. Okay, here is the data that you can see. If you do 7 years minimum gold SIPs, then 70% possibility is there that you are likely to generate more than 10% CAGR returns in gold given the past track record. See, none of this you can forecast for future. Okay, but past is telling us these data points that we need to put in our investing style. So if you are an SIP investor, I would highly urge that do not start an SIP if you do not have a minimum 7 years of time horizon. Once you start it, then you should not stop it. If you stop it for whatever reason, then, I don't know what happens to your returns. So please make sure you follow this strategy as well. Very, very powerful, simple rule. Whenever you want to do SIP, minimum 7 years of thinking you need to have. Strategy number 4 is 5-year holding strategy. So if you invest in direct stocks, one of the normal question or common question is how long we should hold the stocks for. Now there is no definitive answer. It really depends on stock to stock, right? Some stocks you might want to hold only for 1 year. Some you might want to leave it for 10 years or so. But there is an interesting study that I did on the top 500 stocks. And this is very, very important. Let me walk you through. Allow me 1 to 2 minutes of time. So if I look at top 500 stocks, out of the top 500 stocks, there are only 400 stocks that have been listed for 5 years or more. Okay, so my universe then comes out to be only 400 stocks. Now, out of these 400 stocks, if I look at the last 5 years CAGR returns, annual returns, okay, on a cumulative basis, then what happens? 341 stocks have generated positive CAGR, while 59 stocks have generated negative CAGR, meaning 85% stocks have given positive returns if you hold them for more than 5 years, okay, while only 15% stocks have generated negative returns. Now within the positive returns also, if I break it down further for you, out of these 341 stock, there was only one stock that generated around 356% CAGR. This is massive, okay. 2 stocks generated more than 100% CAGR returns. So there are 2-3 multi-baggers if you look at cumulatively annual basis, okay. While around 35 stocks generated more than 50% CAGR returns, 124 stocks generated more than 25% returns. So just imagine, out of the 400, 124 stocks generated more than 25% returns, okay. While around 292 stocks generated more than 7% CAGR returns. Why 7% I used as a figure here? Because I wanted to see how many stocks have beaten FD returns, and that number is very, very high. 292 stocks have beaten FD returns if you hold them for 5 years. Now I'm not saying that this is likely to be case in the future, but this has given me something to work with, right? Now coming back to those 59 stocks that generated negative returns, how much losses they made. So let me break it down for you. The maximum loss the stock made, one stock that made, was around 18% CAGR, meaning every year 18% was lost, okay? And from the remaining stocks, around 7 stocks generated around 10% or more losses, and remaining stocks generated lower than 10% returns, negative returns. Point is very, very simple. If you are a direct stock investor, your holding period will decide whether you make money or whether you lose money. And what I've seen is 5 years seems to be a very, very good holding period. The chances of losses reduces dramatically. Of course, we cannot deny the possibility of making losses, but 5 years is a very, very good time period that you need to know. This study I had posted on my YouTube community as well. If you want to join my YouTube community, you are most welcome. Simply go to my channel, hit that subscribe button, and then join my community. The feedback of the community has been very good. I try to post very, very regularly, so you are going to learn a lot. With that, let's move to our strategy number 5 now. Number 5 is very, very simple. In fact, I'll show you live demo. The strategy is limit order strategy. So whenever I buy any stocks, I do not place market order. I always put limit order. And in fact, I put 3 limit orders so that I can average out my buying price. How to do that? Very, very simple. I am on Zerodha. You might be using any other demat account. Doesn't really matter. I am sure every broker will provide you this option. Here in Zerodha, for example, you go to the basket, okay, and let's say, I don't know, any stock you make up. Let's go for Reliance. Okay, again, not a recommendation here. What you can do here is, for example, Reliance, you can add 3 times here. Okay, so I am adding Reliance 3 times. So I've added Reliance 3 times here. Now what you can do is put a limit order here. So first one I will go and put it, let's say 1275. The next one I will put at, let's say 1270. And the third one I will put at, let's say 1268. Okay, you can put any price that you want. The idea is that in case the price drops during the day, at least you're able to catch it at 3 different various points. Okay, you don't want to put all of your money in one go. And this is very, very important for people who are putting lakhs of money in stock. So generally, order size for me is huge. It's very, very high. Therefore, I need to be really careful that I'm not just buying at market price. Stock prices move a lot, you know, during the day. So therefore, general rule that I follow is I put 3 limit orders. You can go and just place these orders now, and if the order gets executed, great. If it doesn't, then you can wait it. You don't need to buy all your quantities in one go. That's important because market fluctuates, right? So in this video, I've tried to give you 5 strategies that I personally use, and they are built around the 2 rules that I described in the beginning of this video. I hope you like this video. Also, I've given you the link of the stable money in the description and in the pinned comment. You can go and explore the platform. It's a wonderful platform. I'm going to see you in my next video. Until then, keep rocking.